want to welcome everybody to another very special Yahoo Finance Plus webinar. We have Liz Young, Head of Investment Strategy over at Sofi. She's going to join us in a minute here. And the title of this webinar is Fighting the 2022 Bear Market as the Fed Fights Inflation. We got some interesting thoughts on that. Just want to do a little housekeeping work here. We're going to do some polls. We're going to do one in about 30 seconds here. You can ask questions. We will try to get to as many as possible. We really encourage that. We want this to be interactive. We want this to be educational and fun for you. So let's start off with a poll here. Poll number 2 is, let me get to my notes. Do you think the bottom in stocks is in? That's the first poll. So you bet, I'm all in. The new bull market is underway. Not sure, but waiting in. Not sure and staying in cash. Or are you kidding? We are in a bear market. So let's welcome Liz into the stream here. Liz, really appreciate you stopping by. And we had an interesting conversation earlier today. And the title of this webinar, Fighting the Bear, all right? Maybe it's not a bear because every bear market ends and every bull market begins with a low. So are we there now?
Well, technically, we're not anymore, I suppose, because a bear market is beyond 20% down. I think we are out of that. However, I think there are a lot of people out there who have wanted to jump on the bull bandwagon and say it's all over, everything's fine. We had that really big rally earlier in the week. Unfortunately, I don't think it's quite over yet. And the reason I say that is because there is still a lot of data that we have to get through. And that data is going to be data about earnings. It's going to be data about the economy. And in order to really feel confident that we have bottomed and the worst is behind us, we need both of those things to come down to probably a more reasonable level, given where we are with inflation and given the trajectory of what the Federal Reserve intends to do.
All right, I want to follow up on that in a second, but let me just get to the poll results. Well, it looks like we're still trickling in here. So let me just follow up on your definition of a bear market. There are a lot of different opinions out there. Traders tend to look at things differently than economists. And then you have the 20% down rule, which you just said. What is a bear market to you and what is a bull?
Well, so a bear market, I do use that definition. You have to get beyond 20%. And the reason why I think that's important is because with all of the electronic trading that goes on, there are triggers at certain levels. And that 20% level is certainly a trigger. But here's the other reason it's important. Because once we start approaching it, and this time was interesting because we approached that 20% level and we didn't come down off of it for a while. We didn't cross over into 20% for a while. So we kind of chopped around right around it. However, once you get there, that's when the market has to decide, do we deserve to be in a bear market? And how bad does it have to get? And here's what I would say. On average, when you have a bear market, and I'm defining it as 20%, when you have a bear market without a recession, on average, the drawdown has been 28%. When you have a bear market with a recession, on average, the drawdown has been more than 40%. So we're in that weird in-between phase where the market's trying to decide, okay, is this a recession bear or is this just a bear? In which case, maybe we went down far enough. But we're not going to know whether or not this is a recession bear until at least next week and probably even further into the year.
That's right. And the official recession, and you mentioned the R word, the official recession is called by the National Bureau of Economic, NBER, and they were so late to the game in 2008, 2009. I don't think we knew the bear or the recession was officially over for another year there. Let me get to the results of this poll. You bet I'm all in. Only 5%, 1 out of 21. Not sure, but waiting in, that was 67%. Not sure, staying in cash, almost 20%. And are you kidding? We are in a bear market. That's 10%. All right, so we got that. I want to pull up, I want to go to another poll first, and then maybe we can get back in and answer some questions. Poll number 1, or this is in my numbering. When did you start investing trading? Is it less than a year, 1 to 2 years, 3 to 5 years, 5 to 10, or 10 plus? And I see things rolling in here. We got some veterans, we got some newbies, and we always like to see a good mix. So Liz, I'm going to field one of the questions from that was submitted when people registered for this event, and it has to do with 60-40. This comes from Dan Long. Are bonds going to be an attractive option once the Fed gets through a Fed rate hike? And do you see a 60-40 model portfolio, I guess, doing well because it's been terrible this year so far?
So I actually think bonds are an okay option right now. And I think I started talking about them a couple months ago as yields rose and we saw a sell-off in bonds that we haven't seen in many, many years. That's coming on the heels of what you've heard many times, a 40-year bull market in bonds, which is very uncharacteristic of that asset class. But I think right now, because there is recession fear in the air, and because I think we're getting to the point where the Fed is going to have to say, okay, you know what? It's working. Things are coming down. Inflation is slowly making its way down. I don't know that yields are going that much higher from here. So I think it's okay to be entering bonds here if you haven't had bonds in your portfolio. And always remember, when you're constructing your portfolio, it's a three-legged stool, okay? The first leg of that stool is preservation. The second leg might be income, if that's something you're focused on. And then the third leg is growth. And you have to decide which one of those is most important to you and then rank them in order. And that's how the assets that you put in your portfolio should reflect. So if you're worried about preserving capital, in this environment, I do think that bonds can work if recession fears continue to get worse and worse, because that's a time when you see things like the 10-year yield rally, you see people flow back into really high quality securities. Bonds are one of those.
All right, I just pulled up a long-term chart of the 10-year Treasury note yield. Ties into what you're talking about, yield moving inversely to price, but you can see we are in a very long down channel, downtrend, and we are just poking above these levels here. And this was a very fast and furious move. I'm just wondering, do you think about, and this is very long-term, what it means when rates finally break this big downtrend and they trend upwards again, or at least sideways at a higher level?
Well, it means a couple things. I mean, this happened because inflation hasn't been where it is today in 40 years. And it was clear that it wasn't just a US phenomenon, it was a global phenomenon. And everybody around the globe is fighting inflation, which then means that central banks have to react. And almost every central bank has a stated mandate that says they have to try at least to keep prices stable. So this is something that is reflecting the idea that central banks were going to raise rates, which is exactly what we're in the middle of right now. The ECB raised rates by 50 basis points today. Canada was 100 basis points last week. So we're obviously in a cycle where central banks are trying to fight inflation. Now, the spike up in yields was a reaction to that idea. And remember, the Fed just started doing this in March of this year. I know it feels like it's been happening for a lot longer than that. Really, we have not been in this hiking cycle for very long. The next level that's going to be interesting is when the Fed funds rate, starts to approach the yield on the 10-year Treasury. That tends to be a time where the market gets a little uncomfortable, because if the Fed raises the rate markedly above the 10-year yield, that usually is not something that markets welcome. That usually causes volatility in the stock market. Right now, we're not there yet. We've got a Fed funds rate that's an upper bound of 175, but next week could very quickly take that upper bound to 2.5. So when you have a Treasury that's hovering around, let's say 2.93%, if we go up another 75 basis points from the Fed next week, we're in the ballpark where the Fed funds rate is right around that 10-year Treasury rate. And then the September meeting will be the one where, if it stayed steady, the Fed funds rate might go above the 10-year Treasury rate. So I think after next week's meeting, this is going to be a really interesting stock bond mix to watch.
Yeah, and let me just ask you about the dollar here, because that kind of ties into rates. And I'm going to, let me see if I can share a chart of the Dixie. Now, this is a US dollar index. It's heavily weighted to Europe, Euro, and also the pound. But this goes back to, let's see, 2017. I'm going to put some more history in here. We haven't seen levels in this area since way back in 2002. So we're talking about 20 years, another 2-decade-er, as you've been noting in your Twitter feed here. The dollar puts a lot of headwinds on a lot of different markets. Just wondering what your thoughts on the dollar are. Is the move like the move, is the move, I guess, done for now? And what do you think if the dollar heads higher?
I don't know that it's going to get that much higher. It could, but I will say so always remember, currency is a relative game, right? So this particular index looks like an absolute index, but it's always a relative game, meaning it's this currency compared to that currency. So it's always the strength compared to another currency. it could go higher from here. And here's the thing, a strong dollar is usually a headwind to multinational corporations because they get a lot of their international revenue. Sometimes the mix can be 60-40 even. So when you look at a lot of corporations getting international revenue, the dollar is usually a headwind to that. It's also been a headwind to GDP this year. So if you look at what happened in the first quarter, we had a negative GDP print because trade was a drag. Well, trade was a drag for a couple different reasons, but one of them that was a big reason was a strong dollar. How does that happen? I want to make sure people understand this. When the dollar is strong, first of all, when we export goods, that's positive for our economy. When we import goods, it counts as a negative for our economy. When the dollar is strong, our exports are more expensive to other countries, so they buy less of them. We were importing much more than we were exporting in the first quarter, which is why trade became such a drag on the GDP number. The dollar has stayed strong, so it's probably going to be another drag, maybe not as big of a drag, but it's still a drag. It's also, again, a headwind for those multinational corporations. Now, the question was, do we think it is going to keep going up? Do we think it falls from here? I think it at least stays strong. I don't know how much further it could go up. The reason I think it at least stays strong is because even though we have our own set of problems in the United States, we are still stronger as an economy than a lot of other nations around the globe, in which case you see capital flow here more than you see it flow towards something like Europe, for example. So I think the dollar strength is here for a while.
Right. I want to get to the results of our last poll. That's when did you start investing trading? One person said less than a year, 13% said 1 to 2 years, and also 13% 2 to 5, 5 to 10, 22%, 10% or 10 years plus, almost 50% there. And we're going, yes, we got some veterans in the room. We're going to go to poll number 4 here. What is the best recession indicator forecaster? Is it U.S. Treasury 2-year, 10-year spread? Is it 2 months of negative GDP, U.S. Treasury 3-month 10-year spread, or life is a box of chocolates? You never know what you're going to get. We'll keep that up for a minute. And I want to get to another question here from the audience. And again, we highly encourage you to submit your questions here so that we can take them in real time. Do you think tech stocks will regain the amount of losses it has lost recently? For example, Upstart, Aura. I think this is a question a lot of investors have because we've seen some of these stocks like Peloton get cut 90%. And I like to remind people that a stock goes down 90%, has to go up 900% in order to get back to break even. That takes a while, and a lot of times it doesn't ever happen. Your thoughts on this, Liz?
Yeah, so I can't talk about individual securities. Sure. I have a feeling somebody wanted to ask me about Sofi, but I cannot talk about that. So here's what I would say. There has been a lot of what I would call multiple contraction in those tech stocks. Now, if you're asking, do I think the entire tech sector can get back to where it was? No, at least not anytime soon, because the reality is that we're still in a situation with high inflation and with tighter monetary policy, which means higher discount rates. And a lot of what allowed tech stocks to get to that level before was a function of having really low discount rates. So as long as those rates stay high, we have a headwind for tech, or at least a sort of a ceiling on those high growth stocks. Now, what I talked about a little bit before, of the 10-year could still come down from here if there's recession fear in the economy. That is a tailwind typically for those growth stocks. So you're seeing, I think today still, I haven't checked it in the last 45 minutes or so, but the NASDAQ has been doing better than the other two indices because the 10-year yield had come down. So if the 10-year continues to come down, or rates overall continue to come down, you should see strength in the NASDAQ relative to some of the other indices that aren't quite as tech heavy.
All right, we got the results of the poll. The U.S., so the question was, what's the best recession indicator forecaster? Is it the 2-year, 10-year spread? 30% said that. 2 months of negative GDP, that's 30%. U.S. Treasury 3 months, 10-year spread, about 25%. And life is a box of chocolates. Reference to Forrest Gump, excuse me for the noise, 30%. So we talked about this a little bit before, and I think we covered that fairly well. I want to do a thought experiment here. What we were talking about at the, well, we talked about this earlier. People have been waiting for the Fed to pivot. I say they're waiting for the Fed to blink, and I think you kind of agree with maybe with that terminology or a different word. But we're not going to get any big movement or from the Fed anytime soon, because we need more CPI prints to come in. We need more economic data, and we just need a lot more in general. I'm just wondering what your thoughts are when the Fed eventually starts to take off the brakes.
So I want to talk about the poll first, too.
Okay.
The recession indicator. So 2 consecutive quarters of negative GDP confirms a recession, but it doesn't forecast one, right? And when you look at how do you forecast a recession, now the yield curve, the 2s, 10s yield spread is a decent forecaster, but the problem is defining what really counts as an inversion is a different answer depending on who you ask. I think, earlier in the year, we had a brief and shallow inversion, and then we had another one that was like a whisker of an inversion. Now, this one is a little bit more notable. So we're inverted by over 20 basis points. It's lasted a couple of weeks. That's probably more like a true inversion. However, I think actually a better forecaster or indicator to watch is what's called the near-term forward spread. And what that is, and this is a little complicated, but what that is the current 3-month Treasury yield compared to the expectation of the 3-month Treasury yield in 18 months. Okay, so why does that matter? It matters because what it's supposed to indicate is when the Fed will have to cut rates. So if the 3-month yield in 18 months is lower than it is today, that would indicate that sometime between now and 18 months from now, the Fed had to cut rates, likely because of a recession or some sort of really bad softening in economic data. That spread is not inverted at this point. It's tight, but it's not inverted. And it's tightened by 200 basis points since April, but it's not inverted yet. But I would keep an eye on that. As far as, what happens in the recession, and I'm forgetting the rest of the question. What was the rest of the thought experiment?
So what happens? What do you need to see from the Fed in order to say, okay, right, they're pivoting now, or they're blinking now?
Yeah. Okay. Also, let's define what the word pivot means. To me, a pivot means that they start moving in the other direction, right? I don't know anybody if you've played basketball, when you pivot, you change direction.
Yes.
Right? My dad was a basketball coach for 36 years, so I've done a lot of pivoting. But when you pivot, you change directions, right? So to me, a pivot is when they stop hiking, whether that's a pause or a cut. That's a pivot. They could perhaps reduce the size of the hike. I don't see that as a pivot. I see that as a slowing in their policy tightening, right? Right now, the market is expecting them to reduce the size of their hikes in September. So it's expecting 75 basis points next week, 50 basis points in September. I don't think that's a pivot, but I do think that would be met by perhaps some positivity in the market, only if it's coupled by 3 consecutive months of inflation, month-over-month inflation coming down, right? So that, unfortunately, we won't have possibly until October. So if you think about, we're going to get the July data, that could be the first month, and then the August data, and then the September data, that would be 3 months in a row, but we won't find out about the September data until October. So there's some time before we're going to say, okay, you know what? They stopped hiking by as much, and they did it because inflation is coming down. It's working. If, on the other hand, they stop hiking by as much because the economy has gotten notably worse, that may not be met by such positivity in the market, right? That would scare the market. If we know that they're slowing down because they say something like, you know what, labor market, we're not feeling as comfortable anymore, so we're going to slow this down. It's all about the messaging.
Got it. We're going to shift gears here. I think we got poll 6. Let's do that one next. What is the most important part of investing or trading for you? There's no wrong answers here. Just kind of a feeling you out. Risk management, having a trading plan, cash preservation, the Fed is in print mode, or I'm a fly by the seat of my pants kind of investor. We'll get to that in a second. So here's my pivot. We want to talk about oil. We talked about the dollar, and this kind of relates to that. What is going on with oil? By Tristan. What's going on with oil?
What isn't going on with oil is kind of how I feel right now. I guess I'll start with the punchline. I am not somebody who's a big energy bull right now, not because I don't think it's going to stay high. I do think that prices will stay elevated unless we go into a recession. But it's because I think we saw the big spike already. And now we're sort of in this range where we're waiting to find out whether or not there's going to be a demand destruction or a lowering of demand, which would affect the price of oil. And because it's so affected by some things that are completely out of our control and completely difficult to forecast and foresee, such
like
as
wars.
A war between Russia, Ukraine, and any statement that comes out of the Middle East or OPEC about the supply of oil, or who knows what'll come out of the war in Russia and Ukraine. That could de-escalate tomorrow for all we know, right? So the thing about oil and a lot of commodities, especially the ones that are so affected by supply and demand, is that the chart, when you look at it after a little while, when it changes direction, it can look like blunt force trauma. And you as an investor cannot catch that on that downtrend. It just happens so fast that you can't possibly catch it and protect yourself. So for me, in this environment, because I think we're getting to a point where you can wade back in to some of the sectors that you like and some of the asset classes that you like, and I think you're going to get a lower chance to do it. The energy sector is not a place that I'm willing to put a ton of my capital in and say, okay, I hope it works out. I think there's just too much risk and it's not worth it at this point.
I think it's worth remembering that WTI all-time high was just short of $150 in 2007, 2008. And towards the end of 2008 into early 2009, it crashed down to $30 a barrel while the Fed was cutting interest rates. So I want to get to the results of our last poll. What's the most important part of trading for you? Risk management and having a trading plan were the two biggest answers. Each got 47%. I'm happy because I've asked this before. And the answers were different. Cash preservation, 5%. Fed in print mode, nobody. I'm a fly by the seat of my pants kind of investor. Two of you said that. Let's talk about having a trading plan and risk management and the investors watching their own backs right now, because most people have had a drubbing this year, Liz.
Yeah. Okay, here's what I would say. Look, if you're a fly by the seat of your pants investor, you probably get it right almost as often as people who have planned it really well. Here's the point of planning. The point of planning is to try to remove the emotion from the equation. And if you have a solid plan in place, for example, if you have a plan, let's say for the next 60 days that you want to start averaging back into the market, that plan might look something like, okay, I've got this chunk of money, let's call it $1,000 just to keep it easy. I've got $1,000. I want to put it into the market by the end of September, right? That's plan number one. Then the next plan is I'm going to do that by investing about $100 every Monday until it's gone, right? That's an okay plan, because then you don't have to try to figure out, oh gosh, should I wait until tomorrow? Should I do it today? There's bad news on whatever stock. Should I wait until it goes down further? Because then you're second guessing yourself. You're letting emotion get in the way, and you're trying not to make any mistakes at all, when in reality, we're all going to make mistakes, and you probably can't call the bottom on every single stock and every single thing that you're doing, and certainly not on the market as a whole. So planning and risk management takes that emotional piece out of it. When you're making investing decisions based on that sort of FOMO or excessive fear, you're likely to make more mistakes. Now, fly by the seat of my pants, I think that's sometimes it's okay from a timing perspective, to be frank, because nobody can predict it. The only thing I would say is make sure that you're still diversifying your portfolio. So you could be fly by the seat of your pants and really, really like tech stocks because that's what you work in and that's what you're familiar with, and you just like the names, you use all the products. I totally get that. But make sure that you have exposure to other things that might sound maybe a little boring to you, that might sound like, you know, something that only old people would buy. I don't know, whatever the case may be.
Yeah.
Make sure that you are diversifying it still.
Great. Here's a question from Joshua West. It's related. What education would you prioritize a novice seeking preparation of the forecasted market? So education, really big. I like your answer just now. So go for it, please.
I'm assuming we mean education of if you're an investor right now and you're kind of learning as you go. We're not talking about going back to school and getting a degree.
I think so.
I would recommend, I mean, the only real way to learn is by doing, but I would also recommend on a daily basis, especially in earnings season, this is really important. watch the reports of companies that you understand and try to figure out what's under the surface of them. So let's say a company missed on earnings. Why did they miss? Why did they say that they missed? Did they have an inventory problem, for example? Okay. And I'm just trying to take you through an example so that you understand how the education piece goes. So let's take, I won't say specific names. Let's take a large retailer that perhaps would have reported last quarter that they had an inventory issue. Okay. And that inventory issue was a drag on their earnings. I would go back and listen to why that inventory issue occurred. You would find out that the inventory issue occurred because they miscalculated what the consumer was going to buy. How did they miscalculate it? They miscalculated it because the consumer changed their mind, right? So what happened was consumers started to spend money on other stuff. And here's what happens. Then you get kind of down this rabbit hole. Okay, then you start looking into consumer spending. And a lot of this data is absolutely publicly available. You can find consumer spending data on the Bureau of Labor Statistics. You can find it on the Bureau of Economic Analysis. All of this is publicly available on the internet. You can download the data yourself, the whole thing. Then you start to dig into, okay, how did consumer spending change? And what I would say about educating yourself is try to take the thought all the way through and figure out at the end, all right, what was the macro environment over that period? How did it affect the corporation? And that's what you find out from earnings. And then last, how did the market react to it? And that's a good formula. So you take macro, corporation, market. That's how you start to understand how the market reacts in different scenarios, why the market reacts in different scenarios. And you'll feel like the next time something happens or you get a bit of news that's a surprise, you'll feel a little better prepared to either trade on it or not trade on it, right? Or figure out maybe what the opportunity is that it presents tomorrow.
Liz, that's really great advice. When are you writing your first book or next book? I couldn't find any on Amazon.
I don't have time right now, but someday it's on the bucket list to write a book.
Yeah, that was clever because there were two of those that happened in one day, and those were huge surprises that you just don't see. Let's stick with earnings. Actually, we got to do poll 3, if we can pull that up. I think the greatest risk to stocks right now is what? Recession, Fed fighting inflation, strong U.S. dollar, Russia, Ukraine, COVID lockdowns. Obviously, no correct answer here. But I want to follow up on earnings. We chatted about this too. A lot of analysts saying, well, the EPS estimates, those haven't come down yet, and we're in the thick of it, or we're getting into the thick of it. What are you seeing and what are you expecting?
Yeah, so the rubber really hits the road next week. Next week alone, I think there's 168 S&P components reporting. It's more than 33% of the entire index. So by the end of next week, we're going to have a really good gauge of where earnings are this season. So far, companies are still beating. Now, look, they always beat, right? Unless we're in the middle of some kind of earnings contraction, companies usually beat. That's just how this works. I don't know why, but they're beating by about 4%. So we call it a surprise, right? So positive surprise is about 4%. I don't know. I don't have that factored in for whatever's happened today, but 4%. On average, that number is about 9% or 10%. Okay. So we're still beating, but beating by a lower percent than average. What I think we might hear next week, and these are companies across a lot of different sectors. We're going to hear from a number of consumer companies. We're going to hear from transportation companies. And what I mean by that, like UPS, right? We're going to hear from companies like that. We'll hear from some industrials, some materials companies, tech companies, and the ones that are goods sensitive, meaning the ones that make stuff, the ones that make widgets and sell it to people, are the ones where you're probably going to hear about inflation having squeezed their profit margins and that they had to absorb it instead of pass it all along to customers. And we're going to hear everybody's outlook for the rest of the year and maybe into 2023. So if earnings are going to come down, if earnings estimates are going to come down, they're going to really start coming down next week and then the week after. So that's definitely something to watch. It's another reason why I keep saying, let's wait through the end of July, because we've got so much happening next week. It could be a real whipsaw week. We've got so many earnings, we've got a Fed meeting, and we've got GDP.
Let's go over the results to this poll. Greatest risk to stocks right now, recession got the biggest percentage, that's 50%, half of you. Fed fighting inflation, 22%, strong US dollar, 6%, Russia, Ukraine, 17%, and COVID lockdowns, 6%. So recession still top of mind here. I want to remind you guys, ask questions, and thank you for the compliment. This is why, Guy. If you got a question for us, we'll be happy to take it here. And speaking of questions, let's get to one right now. This kind of gets back to what we were talking about, investor education. Let's see. I'm sorry, I lost my place here. As someone who is learning to invest in turbulent times, I would like to know what tips you have for learning and improvement. That is by Vinayaka Thompson. Liz.
Well, I mean, look, I say this a lot to younger investors, especially. The first bear market you go through as an investor will shape you for the rest of your investing life. Now, it doesn't mean that you can never change your mind, that you can't learn more, but it will shape you and you'll remember it. You'll remember how much you lost. You'll remember what caused it. You'll know what the environment was. The only real way to learn through that is to keep doing it. I think the worst thing you can do is pull all your money out, put it under the mattress and say, I'm not doing it again until everything is better. Because if you look at a long-term chart of the S&P and you look at even just 10-year periods, there is not a 10-year period where it goes down. Maybe it's flat. The worst that's happened, I think, is that it's been flat, but generally speaking, it still goes up. So over the long term, still goes up. That said, you can read books. There are a lot of good investing books out there. It's going to depend on what you're into and how deep you really want to dig. There are a lot of really classic ones out there. So I would do some searches on maybe the classic investing books. I'm thinking of things like The Intelligent Investor, right? Things like that. But some of those are pretty deep, pretty granular, and could be too much for somebody who's doing this more for sport than really trying to do it academically. But you can also look at books like The Psychology of Money, right? Things that are talking about behavioral investing and what that really means. You can look at books by different financial advisors and really how they think about constructing a portfolio, how they think about a timeline. And again, you have to do this every day. You have to be looking at it consistently. You have to be reading the news. You have to be understanding how the news has affected the market. And over time, it starts to really click. So it is something that's a discipline. It is something that you have to just continue exposing yourself to.
I think that's great. I'll add a little bit here. Trading is a business, and I think people should treat it as one if you're not a passive investor, because the competition is hedge funds with billions of dollars, and they have processes like you wouldn't even believe, not you, Liz, but most people wouldn't believe how much they scour and their trading books, how they review their theses every single day. There's a reason that they don't sleep. Also, you also mentioned that the first bear market shapes you, and the bear market, the last bear market before this was a COVID one, but it was so quick that most people blinked and it was kind of over. We didn't have new investors. The stimmy checks weren't going out yet, so for a lot of people, for a lot of the new people, this is their first one. But going back to that COVID bear market, what do you think about that? The fastest one in history, and I think the fastest bull in history as well, getting back to new all-time highs.
Well, the way we go into it matters. And that bear market was caused by such an abrupt shock. And what we saw, the response that we saw from fiscal and monetary authorities was just as abrupt, right? It was just as fast. There was immediate and emergency rate cuts. I mean, we had 4 days, and this is just a side story, but I was actually at the New York Stock Exchange. I think it was the 3rd time that we hit the circuit breaker down.
I was there that morning.
This happened last March, and it was the 3rd time that we hit circuit breaker down. And I'll tell you, it was eerie. I will never forget that. I will never forget when that bell rang and the market closed and we halted trading because we had gone down too far. That was a very abrupt, very dramatic spike and stab down, right? And that was a time when we bounced back out of it from a market perspective, but we did not bounce back out necessarily from an economic perspective. Those lockdowns lasted much longer than I think any of us expected. And when we came out of them, then we had an inflation problem, right? We had a supply chain problem. So I would argue, yes, the market reaction was quick, but the economic recovery that occurred afterwards has been a little bumpy. And I think, for people that are experiencing this as their first bear market, it's probably felt really long too, because we've sort of grinded lower over the last 6 to 8 months, depending on what index you're looking at. The NASDAQ started grinding lower last November. So it feels like this has lasted forever, but realistically, bear markets do tend to last longer than, a week and a half. So you will remember this. And when you go through your next one, maybe it won't seem so bad, or maybe you can set your expectations better. I think that the hardest part of being a new investor and a new bear market investor is to not know when it might be over and not know what's normal, so to speak.
Couldn't have put it better myself. It's time for me to do a little show here on Yahoo Finance Plus. You guys are all members. Some of you might have gotten the free trial, so apologies if I go over something too basic for you. But here is our dashboard. Welcome, Jared. And I put in a little watch list. This was a few years ago. You can see underperforming the market by quite a bit, probably because it's not diversified. If you take a look right here, diversification, 51% of the stocks are exposed to the others sector. And if we click through here, we can see some interesting stats and helpful things at the top of the screen. Here's the annual performance, little squid graph there. Risk profile, moderately aggressive. Valuation, based on the Peter Lynch model, 6 are overvalued. So you can see maybe you're taking on a little bit too much risk. And then we have diversity, 36, what is that? 30.6% in the communication services. Sounds like a little bit much for this market. And let's take a look down here, because this is going to show you where your portfolio is allocated. And I think I've showed this before. I'm going to skip over to let's see if we can get community insights. So this is one of the features that has been added, I believe, over the last year, and it keeps getting better. This is based on proprietary Yahoo Finance data of people visiting our ticker pages. That's where we get the trending tickers info that's free on our site, but this goes into a lot more detail. And as you know, you can upload your portfolio to Yahoo Finance, and we aggregate the data and we show you what people are buying and selling. So here we have the most visited companies, and we have Netflix in there, IBM. This is going to be full of earnings names, especially when we're doing those big names in earnings season like we are. And this is helpful as too. You can see what sectors are on the move, or at least top of mind for investors: communication services, which I'm overweight in, apparently, consumer defensive, financial services, etc. And then you have community conversations. Here's one with DD Global. You can click through on here. But portfolio changes, that's what I just talked about. This is very helpful information just to get a sense of what people are buying and selling. One of the first things I do in the morning, because it's part of my job, is look at this to figure out what people are interested in, so I can plan my day, which is a little bit different from the average investors. But having said that, let me move on to research reports. This is another one of my favorite areas. This, you're going to be able to get reports on all the companies that are reporting. You'll get analysis after the fact. So here's one on Amazon.com. You can see this is after their 20-for-1 stock split. It's going to give you all kinds of information. You can download the report. I'm not going to go through it right now. And then finally here, I want to take people through the investment ideas. Let's see if I can get that up. And here we go. So we have investment ideas that are sent throughout the day. And some of them are based on fundamental analysis. Some of them are based on technicals. So here's one on JB Hunt, Schwab, Netflix. Let's click through to Netflix. And you can see Netflix has a bullish trend. And this is a summary of the, let's see if we can get this in a chart. There we go. This is going to tell you on the technicals exactly what's happening. Let me change this from a 1 month to a 1 day and see if we can get this annotated. You'll have to forgive my user operator error here as I'm trying to talk at the same time. So I guess I messed that up, but let's get back there to research reports, excuse me, investment ideas. And has it been a long day yet?
It's been a long year.
Thank you, Liz. Thanks for your support here.
I'm here for you.
I appreciate that. Idea type. Let's get to some of the fundamental ones. So all these are the fundamental ones. And then let's get to the technical ones. For instance, here's one. TGNA forms a continuation diamond wedge pattern, which is bullish. We want to see this in the chart, and it will draw it for you right there. It'll give you a little explanation, what it means, an event description, and these are automatically generated. So these aren't necessarily going to be picture perfect, but this is a starting point for some ideas. Now, I want to get to we got to that result. And here's a question from somebody anonymous. If I'm down 35 to 40% on said retailer who has inventory issues and a significant part of my portfolio, we flip a coin here, figure this one out. Would you suggest selling and moving on to one higher potential ROE trades, or wait, knowing I bought it at an expensive price? And your thoughts, Liz?
Okay, well, yeah, retailer who shall not be mentioned. Again, this is absolutely not specific stock advice. Here's what here are two options I'll give you. There's a thing called tax loss harvesting. You could do that if you have some tax gains. I don't know how many people have gains this year, but yes, if you have some gains that you'd like to offset, you can do something like that. You could sell something that's down in a certain space and buy something that you think replaces it more or less, and still participate in upside that would happen. Or you can replace it with something like a retail ETF, right? But what I would actually say is that we're already seeing some nice optimism in the consumer discretionary names. The two names that we're talking about really were in the staples category, but just in the consumer category overall, what could happen is that if fear really peaks and we find out, you know what, we're going into a recession or we're in one and it's going to get worse, what we probably start to hear in earnings season, especially from consumer discretionary, is them guide down, and the market does have to wade through that. So it could go down further. So unfortunately, you're down 35%, maybe it goes down more, but that also then is likely a good opportunity and a good entry point. So I would say I wouldn't lock in all your losses, because you can't get those back once you sell out of it. And really think about if you can take advantage of tax loss harvesting, and that's something that you want to do, maybe a little bit, but I wouldn't lock it all in as a loss right now.
And yeah, great stuff. And I would add too that a lot of people, there are people who are down 90% in some of their stocks. And if you keep that in your portfolio, you're going to be looking at that for a long time, and it can weigh on you psychologically. And I think that's an important thing to remember. Citigroup is still down 90% from its 2008 high. It's down 90%, just writing about it earlier this morning. We got a little bit of time here. So final question, did you ever play basketball?
I went to a lot of basketball camps when my dad was a coach. I spent a lot of summers at basketball camps. I did actually play for a very brief period when I was a lot younger, sprained my ankle once and said I never wanted to do it again. But I did play softball for my entire childhood up through high school. That was a deal I made with my dad. I wouldn't play basketball, but I would play softball.
All right, that was not the last question. I'm going to give you the field here. Anything you want to add? We got a couple minutes for our viewers as we wrap the session.
Yeah, look, here's what I would say. Sentiment is shifting on a dime right now, and we're still in a period where you could make a decision, make a trade on a Tuesday and feel wrong by midday on Wednesday. That is not an environment where you want to be incredibly active, in my opinion, because you're going to continue to chase your tail in a lot of different things, and it gets really stressful. So again, I want to wait until we're past next week. I want that other data to come in, and I want to give the market a chance to react to it. It's possible that the market likes everything that happens next week, but I am okay with missing the beginning of a rally for a little while, because what we really need to do as investors is avoid those huge, steep drawdowns, because those are the ones that we've talked about a couple times on this show. Those are the ones that take a lot longer to claw your way out of. So I'm okay with missing a little bit on the upside if it prevents me from having an entirely large drawdown in a really quick time frame.
Liz, really looking forward to that book that you don't have time to write right now, but when you do,
we need a ghostwriter. Anybody here a ghostwriter?
Do we have a poll for that? No, we don't.
Yeah.
We are finally out of time here, but it was a pleasure spending this time with you. I hope everybody learned something. Liz Young, Sofi Head of Investment Strategy. And a big thank you to everybody who came here today, participating in our polls and submitting questions as well. We're going to see everyone back in about 1 month. Thanks again.